Aberdeen UK Smaller Companies Growth Trust was launched in August 1993. Managers Abby Glennie and Amanda Yeaman aim to generate long-term capital growth from a diversified portfolio of UK smaller companies, which is made up of 50 to 60 of their highest conviction ideas. The Trust's performance is measured against the Deutsche Numis Smaller Companies plus AIM X Investment Companies Index. The managers believe that there are 7 principles for successful small-cap investing. These are: 1. Focus on quality to enhance return and reduce risk. 2. Look for sustainable growth. 3. Keep the momentum going by running the winning positions and cutting the losers. 4. Concentrate your efforts on suitable companies identified by the Matrix, which is a proprietary screening tool at the heart of the investment process. 5. Invest for the long term. 6. Consider the quality of a company's management team. And 7. Be valuation aware. There is a proprietary, clearly articulated investment process. The Matrix screen has been employed since 1997 and reflects quality, growth, and momentum-based factor analysis. Quality highlights companies that have pricing power, resilient and visible earning streams, and strong balance sheets. Growth identifies businesses that can grow through economic cycles, while momentum signals companies with an ability to beat expectations. Companies that meet the Matrix's quality, growth, and momentum criteria will change over the course of the business cycle. Given the manager's long-term perspective, the average holding period for the Trust's investments is around 7 years, implying an average annual portfolio turnover of around 15%, although some names have been in the fund for more than a decade. Positions may be trimmed or sold if there is a deterioration in the Matrix score, the original investment thesis no longer holds true, they have grown to more than 5% of the portfolio, or there is a higher conviction name identified. In recent years, the stock has been heavily influenced by macroeconomic developments. For example, growth stocks were out of favor during a period of elevated inflation and interest rates. Now inflation has moderated and there is the prospect of lower interest rates, which should be favorable for the performance of growth stocks. This could provide an extra kicker to the Trust's performance, along with the potential for continued positive stock selection. The Trust has outperformed its benchmark over the long term, as the Matrix is nimble and can identify companies with favorable quality, growth, and momentum characteristics throughout a business cycle. The board aims to pay out around a third of the total annual distribution as the interim dividend, with around 2/3 as the final dividend. Revenue from both ordinary and special dividends has picked up nicely following 2 years of depressed income during the global pandemic. While the primary focus is capital growth, the Trust offers a dividend yield of around 2.3%. Importantly, the annual dividend was maintained, even during the pandemic. If you would like to find out more about Aberdeen UK Smaller Companies Growth Trust, please visit Edison Group website.